Excellent. Wow. Thank you very much for joining us today. And it's an absolute pleasure to be the first panel opening the symposium today. And what an honour it is to follow on from Dr. Lisa Cameron, who, is absolutely essential to the UK potentially being the answer to this question. Maybe not right now, still a bit of work to do, but hopefully in the future that will be the answer that we're all hoping for. Before we get stuck in, I'm going to allow the panel to do their introductions. So, James, if I start with yourself, and we're following down the line.
Hi, I'm James. I'm a partner at law firm Gunnar Cook. Been involved in crypto since doing the first ICO in the UK, written about 3% of the world's regulation and specialising currently on go-to-market setup and sales. Gunnar Cook does legal, it does compliance, and also does things like tokenomics, smart contract bills, and the size. There's about 40 of us doing Web3 and crypto.
My name is Chatiza. I work for Fortius. It's the asset management arm of the Numias Group. So Numias Group is all crypto. So in Fortius, we have got, we built access products. So with a fund of fund that comes in dollar and BTC version. So it invests in crypto hedge funds. And then we've got a long only but actively managed token product. So that's on Fortius, where we have got a strategic partnership with Schroders. Then the other side of the business, which is Numias, is a quant hedge fund that's mostly internal money, but just got open to external investors.
My name's Rory Copeland. I'm a senior associate at A&O Sherman, which is a global law firm. I work in digital assets advisory, which is a very global occupation. And that tends to involve a dizzying number of different jurisdictions, their quirks, and really we just bang our heads off innumerable different walls all at the same time. It's a fantastic area to work in.
Hi everyone, my name is Nicky, and one of the founding partners of a regulatory consultancy company called X-Reg Consulting. It's called X-Reg because it's founded and started predominantly by former regulators. And we provide global regulatory advice to our clients. We work with the private sector, so help our clients find the right jurisdiction for them. We help them get authorized. We help them with their ongoing compliance. We also work with the public sector, so we work with jurisdictions that want to develop good regulation for crypto. We assist them with their national risk assessments, so understand what threat vulnerabilities they have in relation to crypto. Before founding X-Reg back in 2019, I worked for the Gibraltar Financial Services Commission, so I was a regulator for 10 years. And during the latter stages of my regulatory career, I worked very closely with the government in the design and implementation of Gibraltar's regime for crypto, which came into force in 2018. And I then headed the team that dealt with all the applications and the ongoing supervision of the sector.
Thank you very much, Nicky. And just to introduce myself, Heather O'Gorman, I am a subject matter expert in payment service and crypto assets at FSCom. Okay, so I think we're going to have a lot of opinions on this panel today. Obviously, you've got a lot of advisors, lawyers and consultants, so I think this is going to be about trying to keep to the time rather than not having enough to say. So just keeping that in mind, gentlemen. I have a great idea. Where should I set up my crypto business? Is probably a question I've been asked at least 3 times this week. I don't know about the majority of yourselves. It's certainly a big question, and I don't think anyone is going to be walking away from here today saying Spain's the right answer after listening to their conversation. I don't think that there is a right or wrong answer, but I think what there are is really important topics and aspects that any firm should be considering from a strategic perspective. And that's ultimately what we're going to look to cover today, is consideration around regulation, around who is advancing well in considerations of tax, where can you test, what are the market access options. So hopefully, as I say, you're not going to be walking away today knowing where you're setting up, but you're going to know what you should be thinking about if doing so. So, James, picking on you first. Starting with regulations, I know that it's certainly one of the questions that firms really ask first is, which jurisdiction is currently providing the clearest regulatory pathway?
So we're now going to play my favorite game, which is the least bad option in the room. So your first starting point is if the majority of the mind of the management of a company is in a jurisdiction, it'll be deemed to be in that jurisdiction. So first of all, your holding company is going to be where the majority of your directors are usually. If you want to get money, US and UK are pretty good jurisdictions for equity raises because you're probably doing equity raise alongside your fundraise. When it comes to where you sell your token, you've got the fundamental question, are you a pirate or are you a cream puff? If thou art a pirate, you need to pick a pirate's jurisdiction. The biggest of the pirate jurisdictions is probably currently Panama, because Panama has no regulation because it feels against the human rights of the world to bother this crap. So if you want to go short-term, video game, 6-month lifespan, Panama is awesome. If you want to go with the vast majority, so you can be a little bit naughty, but not too naughty, BVI is out there. On the grey list, but there's so much money in the BVI, we all pretend it isn't and just look at everyone and go, ooh, no one knows about there's the solution to the BVI. You've then got your second round, which is the cream puffery. Now, the cream puffery is all about selling into jurisdictions. So if you want to sell to Kazakhstan, they want you to have a license. If you want to sell to Botswana, they want you to have a license. This is all pay to play, of which the cheapest game in the room currently is via Europe, where you can get maxes to most things. And if you play your cards right, you can get that number to about 20K by basically leveraging other people. If you want to go more up the screens, go up to 500K if you just hate yourself and like spending money. And then you've got to work out effectively your plant base is. So in terms of where people are going at the moment, majority BVI certainly under threat because those rules have been risen a bit. In terms of clarity, US has absolutely none. Europe has some, but they're all fallen out. So Malta's fallen out the rest of the regulators cutting Europe as to the meaning. So I'd say 80% clarity. UK is about 6% clarity. US is about 20% clarity. Rest of the world, throw a dart, see what happens. Every country, battle it out. Yay!
But before I move on to the programmed questions, does anyone want to add to James's comments?
I sort of agree with James to an extent. There's a lot of bad jurisdictions. You did mention BVI, and maybe sort of like a lot of the smaller jurisdictions, incentivized by the economic benefits of attracting business to their shores, were first to market in terms of trying and bring regulatory certainty. But there are a lot of smaller jurisdictions that have done a very good job of regulating crypto. It doesn't mean that you're going to have zero failures, firms fail. The key thing is that they fail for the right reasons. And one of the things, smaller jurisdictions tend to sometimes get a little bit of stick. But if you're a small jurisdiction and you want to attract business and you're in it for the long game, then you need to strike that balance between having flexibility, applying the laws proportionately to the risks associated with the business, but you need to uphold firms to a high regulatory standards to make sure that you protect the reputation of the jurisdiction.
Yeah.
I think I would probably add that there's increasingly a distinction between the factors that are most relevant if you want to offer crypto to a broad retail market versus if you want to go wholesale or niche. James's video game 6 months lifespan example, we'll call that niche. It used to be the case in crypto that one license was often your passport to the world. That was your trust queue, and you could use that to offer services to the retail market cross-border into lots of different places. That is no longer the case. There are increasingly few jurisdictions with material retail markets who will allow the pirates to come and offer services cross-border. That means that prime amongst the factors that you consider has to be, where are our customers? Yeah. And that is why in the cold light of day, as much as everybody finds MiCA annoying because of the regulatory thresholds. MiCA is nothing on the US with state level, traditionally state level licensing for a lot of these activities, and whatever comes through from Genius and Stable will be demanding, and the UK will probably be demanding as well. They're the three biggest consumer markets in the Western world. You could ask yourself, if Coinbase, if Gemini, if Revolut, as sort of the coolest UK company this week, if they decided they were going to set up in the BVI or Panama all those years ago, would we be talking about them today? Probably not. No, they focused on those jurisdictions where there are customers, and unfortunately, it's very difficult to ignore that.
Thank you. Admire, are you seeing a shift in any particular direction yourself?
Yes, no and yes. So I'm going to make a distinction between, so my experience is in asset management, so particular hedge funds. So make a distinction between the fund, which is the pooled vehicle, and the investment managers. So on the funds, there's no movement there. So the jurisdiction that funds are set up haven't changed much. So for hedge funds, tend to be Cayman. So for other funds, could be Luxembourg, could be Ireland. So people tend not to want to experiment with that for obvious reasons. The infrastructure is well set up, tech is well understood, service providers are there, investor protection laws are very clear. So you leave that. But on the investment manager aspect, so I spent 10 years at UBS doing ODD on hedge funds. Main jurisdictions were US, UK in that order, and then in Asia it was mostly Hong Kong, and then moved to Singapore. But with crypto, I've seen a shift mostly to the BVI and the UAE. And reasons are, one is time to market. So when I went into crypto to set up investment manager in the UK, it was taking 12 to 18 months to get a license. It has come down since, but not materially. So in the UK, most firms that actually set up here went through the appointed rep regime, where you are part of a platform and use their license with the hope that you get your own license in time. So in the UK, that's still common. But if you're going to the BVI, 6 to 8 weeks, you are set up and you're good to go. UAE, same thing. So what I hear about the UAE is that they're just as parallel as, say, the FCA, but they just do it quicker. And the other driver as well is, so for crypto hedge funds in particular, most of the investors as of now is high net worth family offices and crypto institutions. So I don't want to say that they don't place importance on the jurisdiction, but they've got other bigger things to worry about, like counterparty risk of exchanges or risks in DeFi. So they place less emphasis on the reputation of the jurisdiction. So they are okay with managers setting up in the BVI or UAE. They ask less questions. And in the what he says, in the BVI, it's super clear what the regulations are when he's setting up an investment manager.
Interesting. It's interesting to hear the similarities, but also the differences between sort of the traditional markets and potentially crypto as well.
Yeah. So we had some large hedge funds, traditional hedge funds, that were wanting to go into crypto. They were based in the US, UK. But when they're setting up their crypto part of the business, some of them chose, like, say, to set up an entity in the Cayman Islands, for instance, for various reasons. But they tended, so the bigger ones tended to go to UAE. I'm sure the other reasons they go to the UAE is all like access to investors in the UAE. They want to be local. But yeah, I've seen that trend.
Thank you. Nicky, you've got a bit of experience working with offshore jurisdictions. In our sort of preliminary discussions, you'd identified that maybe actually going offshore is becoming less attractive. Maybe would you mind sort of feeding into that a little bit more?
So maybe sort of and it's less attractive. But really, there is still a lot of value in operating from some of the smaller offshore jurisdictions, and I can go into that a little bit more. But as Roy was saying, one of the key factors is because if you want to provide services into a lot of the larger markets, you need to be licensed in that particular jurisdiction. Having said that, there's still about 40% of the world, Latin America, Africa in particular, where crypto is still largely unregulated in a lot of the countries there. So you can still go to a smaller jurisdiction, have the regulatory certainty offered by the regimes, the proportionality, and other flexibilities that are offered, and service these particular markets. There is still the point that depending in some of the jurisdictions, unless you're actively soliciting or unless you have a physical presence, you don't need to get licensed. So there is still the ability to provide services to some extent into some of these countries. But it is true that as more and more countries start to regulate crypto, unless these smaller jurisdictions adapt and evolve, the value will diminish. But the key thing is making sure that they do evolve. So smaller jurisdictions are more nimble and they can implement legislation quicker than a larger jurisdiction. And the value of that is that if you look at the laws in most of the larger jurisdictions, it focuses on the more traditional activities. Small jurisdictions still have a key role to play in trying to be a little bit more innovative and regulating some of the services that are outside of scope of the larger jurisdictions. So if you provide staking, if you're a crypto lending business, if you're providing advice in relation to crypto, that's still unregulated in a lot of these countries. But if you want regulatory certainty and be able to offer these products in a regulated environment, some of the smaller jurisdictions still offer this as an opportunity.
And well, we're moving on, sort of considering not only the actual regulatory regime in those countries, but then the relationship with the regulator. How important do you think that is in deciding where to launch?
I think that your credibility in front of your regulator in crypto is important almost everywhere, because that is, you will not be presumed to be credible. You will be presumed to be somewhere in between incredible and criminal. And so that it's always, or is almost always very important. I think possibly in the asset management context, your credibility will come from previous funds, from who you are and from the legal nature of the vehicle in a more traditional sense, rather than what you're investing in as such. But it is in every other context, it's vital. What's quite interesting to consider when you look at jurisdictions is there are some where you will be able to establish that credibility because the regulator is truly open to engaging with you, to understanding your business, both at the point of licensing and supervision. Yeah. And then there are also many other regulators who are not truly open. Sometimes they have to pretend that they're open because they're within the European Union, and MiCA says, thou shalt be open. Sometimes they're open at a sort of policy level, but they simply don't have the people in the authorizations team to get through applications. And you end up with very long waiting lists. It's all very inviting, but it's a very long queue. And sometimes, which possibly even worse, the people in the authorizations team are very open, but then once you get the license, you're handed over to supervision team, and they are deeply just distrustful. They are not bought in. And I can think of one wonderful example of a European regulator who gave a firm a MiCA license and then slapped them with a large AML fine within 4 weeks. That's really weird. And so there is a process, particularly as regulators change, in deciding with whom you can truly have a relationship where they get you.
That's
I was going to say, I was going to open up to the rest of the panel because I know this is very important.
it's sort of in our experience, it is a very important factor to take into account, the openness and your ability to engage with the regulator. We sort of, when we're helping a firm choose the right jurisdiction for them, there's a lot of factors that we take into account, sort of target markets, products and services that you intend to offer, because ideally you want to be able to offer as many products as possible under one license. So a key example is if you want to do spot crypto and you want to offer derivatives, in some countries you need 2 licenses. So finding a jurisdiction where you can do everything under the one license has its value and its benefits. But one of the other key factors is that accessibility to regulators, being able to sit down, have a sort of grown-up discussion about your business, your products, especially if you want to offer more novel products, investing that time with a regulator at the beginning of what it is you want to do, having a discussion around what are the vulnerabilities, what are the risks, how are you managing that risks, adds a lot of value to the whole process. And I have seen good examples of that, and I've seen poor examples of that where the regulator hasn't been open to engaging at the early stages, and then the authorizations process becomes very painful. Often you see regulators, maybe as a result of lack of experience, knowledge on the sector, asking all the wrong questions. So it is critical.
I think just building on what's been said before, you don't have to pick one country. So most people do a sort of model where you'll pick a pirate nation, you'll pick a non-pirate nation. Do not underestimate the ability of someone to do something really stupid, like announce Bitcoin is now illegal, or every trade that you do has to be monitored. 2017, they announced they're going to make crypto illegal in certain countries. They didn't like it. FINRA in Switzerland once announced that every time you did a trade, you had to basically inform the regulator how you did that when you couldn't actually do the trade, just use your token, someone else's, who knows. Europe announced that Bitcoins were made illegal at one point because it was bad for the environment. UK has announced that stablecoins should be linked to 10K a couple of weeks ago before going actually don't even know what stablecoins are. Ignore us. So we have no idea what we were talking about there. It was just a moment in the bathtub. At any moment, one of these regulators are going to do something you don't see coming, you don't expect. So what you tend to end up with if you want to be swift is you'll need, as you guys say, your presence in the jurisdiction you're going to sell into to the extent required to get them happy, but have your plan B at all time. When the FCA starts kicking out firms, we eradicated one of the largest fintechs out of the UK within 24 hours. That was the day from hell. I don't want to do it again, if you see what I mean. Try not to go to the Binance steroids level, who really took the pirates to the nth level and then turned it into a spectacular, glorious thing. Beauty is in the eye of the beholder, and it was beautiful. But they went too far and then had to backtrack effectively and rejoin the rest of us a little bit. But a little bit of the Binance style, keep frosty, if you see what I mean. It's an evolving picture. As Lisa said before, MPs are trying to do their best, but they will get the fears people coming in their lives. They're going to get the greed people in their lives. People are run on fear and greed. When fear dominates for an afternoon, they are likely to go the wrong way on you. When greed dominates, it may go the wrong way the other way. Bahamas went too greedy with FTX. There is no right answer. There's just people in rooms doing their best to try and get it right. And you are not them. You're your business. So you've got to then claim into that and try and work out what's best for your business. Given that, you've got people around you who possibly haven't ever spoken to you, don't know who you are, but are just sort of guessing the way forward. The FCA banned crypto derivatives. We were trying to launch a product at the time where the derivative was solely to the benefit of the consumer. All it did was protect the consumer, but we couldn't play it because it was a straight ban, if you see what I mean. That's a large hammer coming down to crack a nut, and I'm sitting there going, oh. But that's what you get, if you see what I mean. So you have to sort of keep frosty.
Yeah, so we do that so when we are engaging with mostly custodians, so we said we're going to have one from the US, but one from the UK, one from Jersey, right? If any one of those guys are kicked out, we've got infrastructure where we can park our assets. Otherwise, yeah, you'll be out of business.
I think that diversification's a really important idea, and I think going into your point there, James, as well, about spreading that risk in the right areas and having a global presence is ultimately what we're trying to achieve for most products in this space. We've spoken a lot about licensing, spoken a lot about regulation, and I know that tends to be where the conversations start, well, certainly when I'm having one, but there's a lot of other things that firms should be considering when operating a business, let alone a regulatory crypto asset business. So elements such as reputation, kind of spoken to, the scope the scope of the products that are available, and access to the market. It's just some of the things I can think of off the top of my head. Would anyone on the panel like to think maybe what other aspects are truly important to firms setting up, and what are the key dependencies?
So I can start. So one we see a lot in our sector is access to exchanges. So for businesses that are set up in the US, there are restrictions to onboard with offshore exchanges, and most of the volume is on those offshore exchanges. So for you to access them, you got to set up your business outside of the US. So that's why some of the bigger hedge funds that are going to crypto were setting up in Cayman, for instance, or UAE. So the exchanges tend to be a bit more lenient if your investor base is mostly US. The structuring things you can do, like set up SPVs in between, you can get around it. But if your principal place of business is US, that tends to be a no-no.
I'm going to say 3 words: tax, network, spend. First gig, tax. How much money have you got? How much money do you want to spend reducing your tax? You can spend money up front to reduce your tax later down the line. You get token valuations, you can do that kind of stuff. That means that when the token comes out, you will make more money in the long term, but in the short term, you're going to get hit with a bill. Network. Opening a bank account. We've got a list of banks that we send people to because most banks won't touch you. Do you have a tokenomics guy? Do you have a smart contract guy? Do you have an audit guy? But do you have people on your thing where when you speak to the investors, they go, oh, that's him, that's a good idea. Do you know the guys at Super Team? Because Super Team are funding things. They're putting together office space to move forward. If you don't know them, speaking to them. Get that network sorted, as it were. The crypto guys were never quiet, so you can always talk to them and you'll always get shown towards more and more network. But find the right network side to it. And then spend, do not take your money and spend 5 million quid going to a conference, which one of my guys did. Keep an idea on what spend looks like. You want to be here in 5 minutes. So we've got some clients who got all their money in 2017 and just controlled spend. They're still playing off that 2017 raise. Not saying you have to go to that level, but if you're going to burn money, that's fine. But why are you burning it and why are you bringing it in? Some firms will burn money like crazy, knowing they get more money in because they're playing a high risk stake again. We're going to launch an MTF in crypto assets for tokenized securities. We're going to burn money. Who's going to back us? Oh, BlackRock. They've got lots of money. Problem solved, if you see what I mean. But control the spend to match the nature of the business. If you're going to do a small video game in the middle of nowhere, you're probably not going to want the same level of spend, given that it's a gimmick on top of a game, trying to get a couple of kids to pick up a console for 5 minutes, if you see what I mean. So get the numbers to work.
Yeah. So in our experience, I think once you, beyond the regulation is to some words, but reputation is important. And reputation will have a bearing on your ability to open bank accounts. Speed to market. Remember? Speed to market. So how long is it going to take for you to get a license? Most firms, by the time they approach us, they don't want to have to wait 18 months, 2 years to get a license. They want to move quickly. So that's usually an important factor. Presence requirements. So how many people do you have to have in most jurisdictions? If you want to get a license, you need to have a physical presence so you can have people there accountable to the regulator. So how many people do I need to have on the ground? Can I, the sort of talent pool as well. If you want to establish in a jurisdiction, you need access to good talent, or at least if not, you need to be able to relocate people. So how easy is it to get a visa, etc. Those are some of the other key factors that we tend to consider when selecting the right jurisdiction that goes beyond regulation. Very important factors.
I'd reiterate the talent and the people thing, because it is so annoying to set up in a jurisdiction and just find there aren't enough MLROs to go around, or find frankly that talent is part of your sell. Particularly if you have more sophisticated investors and a more nascent brand, it's the people at the top who are really important. And we think about this a lot when thinking about MiCA jurisdictions, where there are some which are very attractive from a regulatory perspective, but you talk to the recruiters there are inundated trying to hire people from other places to move there. And if you can look down a jobs board and see the same country coming up again and again and again, and those jobs not being filled, that's a problem waiting to happen. And it really does slow you down, because to get good people can take a long time, and getting the wrong people is expensive.
It's such a crucial hire, isn't it? It's an expensive hire. It's often a hire you have to make before you're licensed, so it's an investment, and it's someone that is very likely going to be tested quite heavily by their regulators. So it really does have to be, as you say, the right person, with the right skill set and knowledge and experience. It's a really tough ask, I think, for lots of firms who are starting up.
And Europe is a great example, because now with MiCA, you have harmonized regulation across the EU. So when you're looking at where in Europe do you set up, legislation is really sort of relatively insignificant, because it's the same. This is when some of those other factors, access to talent, tax, access to the regulator as well, preparedness from the regulator. Not all regulators in Europe are as prepared to deal with MiCA than others. How many firms are currently seeking authorization, because that's going to cause delays. So it's a great example of how once you have regulatory harmonization, all the other factors play a more pivotal role in making the right decision.
Yeah, so on the talent point, that's a crucial one as well, because a lot of firms, we see it on the portfolio management and traders aspects. Most traders, they are located in the UK or US, right? And because of remote working, people are like, oh, we can set up anywhere and we can hire PM from the UK. But then turns out, if they're spending most of their time here doing portfolio management duties, that's a regulated activity in the UK. So you need licensing, and that kind of messes your whatever your business strategy is. So yeah, that's a key one: access to talent.
We very lightly touched on tax as one of those considerations. Is tax a really important consideration, strategic consideration when choosing a jurisdiction?
Yes.
Yeah. So in my field, so the fund structure needs to be in a tax neutral jurisdiction. So people don't think about it anymore, but people go to Cayman Island and Cairns for those reasons, right? There are other reasons as well, like investor protections, but yeah, tax is one of them. For the investment managers, it's yes as well, but I think other factors might play a more important role. But for the founders of those, what I've seen is we had guys that were based in the US. So crypto funds tend to be quite small relative to traditional hedge funds. But when they started getting traction on the AUM side, and their performance is like decent, they start earning a decent amount of performance fees. So founders that are non-US people migrated out of the US and went to UAE. They give other reasons like clarity of regulation in the UAE, but they use a huge tax difference there between the two jurisdictions. So that definitely plays a part.
Having said, whilst I think that it's very important and very relevant for people who want to have relatively light businesses that are focused on market, on just being in the markets and profiting from the markets. If you want to build a big brand, and if you want to offer regulated financial services to other people, first of all, chances are you're not going to have a lot of revenue for the first couple of years. Firms are much more, and investors are much more focused on their investments achieving profitability sooner than they used to be. 10 years ago, tax was was largely irrelevant because everyone was burning through cash anyway. That's not quite the case anymore. But it remains the case that if you've got to have some revenue from a customer base to have something worth taxing. And so it becomes secondary or tertiary to revenue and profitability. Except the point that you made earlier about when you're in the EU, when you've just accepted that MiCA applies, suddenly those secondary, tertiary points become more primary.
I don't agree. I think tax should be sorted at the very beginning. Tax got Al Capone. Tax is what destroys businesses, not the FCA. If you have a bad afternoon of the FCA, you have a bad of the FCA, we find a way forward. I'll give you an idea, one, and tax laws are changing also, which is important to know. So if you are a business and you have 100 million tokens, which you've just fabricated as a thing on the spreadsheet, right? 100 million tokens, you sell one token for £10. On your spreadsheet, you've now got £10 plus 100 million on your balance sheet, effectively, which will impact your tax. But you've just got £10 to pay it with, you're insolvent. We've seen this with clients before. It can blow you up. The second thing to be aware of is all that stuff around DAOs. We're going to go, blah, blah, blah. Most of that was get out of tax. The rules and tax are changing off the back of this. So what's happening now is what's happened in the past is you would have your UK entity. Let's say you live in the UK. You have a UK entity. That's where the directors live. That's where your equity goes. That's your IP company. UK entity enters into software agreement with offshore Cayman Foundation. We'll just go for Cayman because it's a low-tax jurisdiction. BVI subsidiary. In the past, that made your token issuance entity, the token seller, tax remote from your UK entity. So basically, you only pay tax when the money went across from your DAO type structure to your UK structure over that. Under the rules coming into force during this year, what will next happen the next tax year is that structure is under threat because unless you have what they call genuine directors, which means directors which are not provided to you by corporate service providers, that entity will be subject to UK tax. So effectively, you're going to get a huge tax bill you don't see coming after having spent an additional 30k on the setup. So your options are now twofold. You either go for what they call real directors, i.e. directors which aren't linked to corporate service providers, and you pick up proper directors across multiple jurisdictions, and you have majority non-UK, or you just bite the bullet and pay tax, at which point you have to structure your token so that it is sold on mint, not minted, and then sold to reduce that part of it, and you have to be in better people than me to sort out the rest of the stuff, because I only see the ones where it gets really bumpy.
My experience, the whole sort of tax wasn't a critical factor in most of the jurisdictional analysis, as we refer to them, that we've done for clients. What we tend to do is sort of we do a little bit of sort of like a deep dive into the product services, where you get to understand what it is that they want to do, what do they want to offer, who they want to target. And then we sort of get them to tell us what are their priorities. So what are the key driving factors, whether it's reputation. More often than not, tax is not even a consideration. And when it is, in terms of the weighting, it's one of the lowest weighting. I'm talking at a time where sort of firms were still seeking that regulatory clarity, which goes back to the point I was saying earlier. We're always say, I think when sort of things become more of a level playing field from a regulatory perspective, that's when sort of tax will become, I think, a more significant factor. We focus predominantly, we've provided services to issuers as well, but we've talking predominantly about regulated business. So your exchanges, your custodians, the incentive is more that stability, regulatory certainty, that ability to offer a wide set of products and services that really drives the initiative to where do I go, as opposed to which jurisdiction has the lowest tax rates.
But bear in mind, regulated businesses generally pay less tax. In Germany, if you're a security token, 0 tax. If you're a non-security token, 19% tax. So I completely hear what you're saying, but if you're a regulated business, it's less priority. If you're an unregulated business, it's a much higher priority. And that's why I think there's a sort of differential on the panel, depending on the sort of people we talk to.
Our focus is on regulated business. So
Nicky, speaking about sort of regulated businesses and the ability to test products, given that pre a regulatory remit, you're not allowed to offer your product to customers. How do you see clients working around that concept? And is there any jurisdiction-friendly places that people tend to set up to be able to product test?
I mean, it's a tricky one. It's a tricky one because most regulatory regimes don't have any thresholds under which you don't need a license. If you are facilitating the exchange of crypto to fiat, crypto to crypto, custody, that's within the remit of most regulatory regimes. And if you want to offer it out of that jurisdiction or into that jurisdiction, you need to be licensed. So it is a bit of a tricky issue to navigate. You always have the option that you could test from an unregulated jurisdiction, but then that comes with other issues such as ability to secure bank accounts, etc. There are some jurisdictions that have sandboxes for testing of products, but they tend to be quite clunky, and you're going to have to invest quite a bit of time in getting approval to be able to test the product, in which case you might as well just get your license and then go to market and test. So it is a bit of a tricky one. You either wait, get your license, or you try and do it in a way that's structured in a way that maybe is unregulated. So in some jurisdictions, if you're prop trading, could be unregulated. So maybe you could do it in a way that will allow you to test the product to some extent, maybe not the full suite, but at least you can start doing something. And if not, you might need to go and find a jurisdiction where your particular activities are unregulated, test. And then once you have your license in another jurisdiction, then you can sort of like do a bit of a, bring the business from one to the other.
I think undoubtedly sandboxes are the best option where they're available. Sandboxes can sometimes become sand traps. And there is a bit of a rule of thumb that where possible, you would go into a sandbox in a jurisdiction that is not the one you would most like to launch in first, because sometimes that can actually become a hindrance. It can't be that. Ideally, the next best option is to establish that your test environment is not being performed by way of business, and there's some. So that's a slightly slippery legal world. Ideally, you would have a regulator to whom you could send that view and say, look, we've had this advice. We don't think this is being done by way of business. And the regulator says, yeah, okay, fine, that's fine. There are plenty of regulators who will reply saying, sorry, we don't give legal advice. So you continue at your peril, and we'll decide what we want to do later. That's rather unhelpful, but very common. And then the third option is that you have a market of principals for whom you can act as an agent or sort of an appointed representative in some commercially viable way.
I feel like there is, we've spoken about a lot of different aspects ultimately. And I think there's some really important different opinions on this panel. And I think that's key, because I think there should be, because I don't think there is a right answer at the moment. And there is so many things to consider depending on the business model, the type, and who your customers are going to be. With that said, if we can maybe start with yourself, James, and move down the panel. Given the conversation, given the question, where should I set up my crypto asset business? What's your 30-second answer?
How much money you got? If you've got, most businesses are trying to have got limited budgets. If you're going to go for limited jurisdiction, BVA and Pound are the top two company for those two. Other markets you can get into with more money, and you've got your primary market, which is the MVP, your test, if you will, type jurisdiction. And then you've got your serious market, and you start hunting your audience, as you said, in terms of setting up in order to meet your audience. So if you've got no money, those are your options. If you've got money, chase your target audience. And last of all, be realistic. We see a lot of people set up things that nobody wants to buy. So do they really want it? Do some strategy. One of the things we've done with clients is we've actually done business analysis in terms of strategy, market fit, go to market. Is there an audience? before you spend money on the lawyers, the setup, the tax, the audit, the advisors, the going around the world trying to get money, and all that joyousness, if you mean to sell a product that no one wants, is a bit heartbreaking.
Sure.
Yeah, so in our world, so as of now, like I said, the investors are not, okay, they're sophisticated enough, but maybe they're not large enough. So they're okay with the BVI, UAE, and the like. But the moment the large institutions, traditional institutions start to come into crypto hedge funds, you might not even get an audience with State Street or BlackRock. So that's where someone might need to start thinking about coming into a jurisdiction that these guys are used to. So like the UK, USA. But as of now, that infrastructure or that clarity isn't there just yet. It will take time. It will also take time for the institutions to come in. But that when they do come in, the asset managers got to be ready.
In the context of regulated financial services businesses, I think my first bit of advice would be to ask your investors what they want to see in a financial sense. A couple of years ago, there was this remarkable thing that happened across a large number of bigger asset managers, where at roughly the same time, they all switched their priorities from growth to profitability. And that came as a real shock to a lot of fintechs and crypto firms who had been planning their route to profitability was a 10-year thing. And now somebody had told them, actually, it's a 1-year thing. So all of this expenditure on expansion and so on is not yet making you any money. You're trying to do all things in all places. Cut it. And that suddenly the priority became, where can we set up? Where is the first place we can set up and generate revenue by the end of this year?
So for me, I think the two most important factors, and we've covered it to some extent, and I think some of is one, what's your target market? So for example, if your main target market is the EU, if you want to be able to actively solicit customers in the European Union, you need to be authorized in the MiCA somewhere within the EU, and then once you're authorized in that member state, you can then passport across the entire. If EU is not a priority for you, my general rule is don't go to the EU, because it's a very complex regulatory environment with and there's certain things that make it difficult for firms to be able to operate. You can't have a shared order book. There's certain things that make it restricted. So first is what's your target market, and then the second key sort of question to ask yourself is, what are the products and services you want to offer to your customers? Is it just spot trading? Do you want to do spot and crypto derivatives, which is one of the most profitable sort of growing areas within crypto? Then that's largely going to drive where you want to go. Ideally, find a jurisdiction where you can do, like I said before, everything under one license, and there's options like in Gibraltar you can do that. In Bahamas, Bermuda, you can do that. There's multiple jurisdictions that allow you to offer both derivatives and spot under the one license. So for me, those are the two key things. It's target markets, products and services you want to offer, and then everything else, reputation, and everything else, operationalization that comes into play.
Thank you. Appreciate all of your insights. Thank you very much. We have about 2 minutes left. If anyone has any questions on the floor, we'd be very happy to take them.
Question on that.
Yeah, question at the front. Just get your...
Hi there.
Oh, sorry. We'll be right back over to you. We'll make sure we get both questions in.
Sure. My name's Evan Channing. I'm a partner at Spence & Fane. We're seeing a significant rise in DATCOs at the moment. I'm curious whether the panel thinks that MEV exploits should be regulated, in particular by DATCOs.
Sorry, what was the rise in?
MEV exploits.
MEV exports, as in staking MEV.
Maximum extractable value?
Yeah, MEV.
Yeah.
So MEV is beginning to become more of a thing. Originally, the regulator knew what MEV was, so we did have a hell light. What's happening at the moment? So we were speaking to a very big regulator who will shoot me if I give you their name about this before. First of all, they thought staking was actually banking. Once we got through that particular car crash, we then rediscovered that staking wasn't banking. And then they basically said they wanted to do something to stop MEV being abused, as also transactions being power tools the wrong way, which is the other issue of in staking. They're going to put in across the globe, I think, pretty much generic market abuse type policies trying to stop it. The big row is currently around FATF and sanctions linked to also how these things are separated as well, because certain validators, they're OFAC compliant, but there's no actual way to know they are. It's a trust-based type thing, unless you do proper, basically, stage-by-stage due diligence you can do after the fact. So MEV is still an issue. It's still running around. It's really quite lucrative at the moment. It's still parts of the Caribbean territory, but market pieces are going to come in. It's going to try and cobble it a bit. I suspect what you're going to end up with is third-rate market piece policies being cross-applied by people that don't know what they're doing. They very hope for the best, is my blunt, honest assessment of it. And as long as it looks like you've tried, I expect the regulators have no idea what they're doing anyway, because you'll probably get away with it for quite a while.
I think if we don't mind, if you've got a quick question down the other end of the hall, I've promised.
Thank you. This is a question for James, because you mentioned the concept of DAOs twice. Once when you were talking about initial setup in terms of how you structure your holding company, and secondly, when you referenced taxation. Now, 18 months ago, DAOs were prevalent in the way people set up because of the flexibility it gave. That was because it allowed for innovation when regulation was starting to catch up. Now we've got regulation, the Genius Act in the US, Maker in Europe, the UK, Singapore. Where do you see DAOs and the concept of DAOs, both the Wyoming, Delaware, and Malta DAOs in your regulatory setup for companies?
Yeah, so the DAOs been interesting. So the first thing about DAOs, not all DAOs are created equal. So most DAOs are a foundation of some variety. The nature of the foundation was originally usually created for charitable purposes, and the first one was in Switzerland. The Swiss DAO is I call the cream puff DAO, because the Swiss put a lot of PR into saying it is awesome, but I'm unconvinced as to what it really gives you as true value. So I'm a no on the Swiss DAO. The Panama DAO is for if you want to go play about in Panama. The Panama DAO does not let you hold a profit. I am a negative on the Panama DAO on that basis. You then have the Cayman DAO, which is what most of the jurisdictions, most people ended up with, either Swiss. So NIA protocol went for Switzerland because it wants to look important and big and special. The guys you've never heard of usually went to Cayman because it's quicker and cheaper to operate. Now, the big joy of the DAO was there were two aspects to it. You've got the cynics debate and you've got the nice guys debate. The cynics went for the DAO because the DAO had no shareholding. And because it had no shareholding, it was not owned by, say, a UK-based entity, and therefore came outside of the UK tax system. Because of that, effectively, you stuck a DAO in the top. You then made a huge speech about how you were decentralized because you're a DAO. It's complete nonsense. Just get out of tax. But you've got the PR win anyway. That particular DAO is, I think, under threat. I don't see the purpose of it. I don't think it works. I don't see there's any role to it. Your second DAO is more the purest DAO. That's more around things like governance. So we've done things, for example, and you'll see it with people like Lido, or would be a good example of people who behave like this. And they have a philosophical basis where they actually want to be decentralized, and they have a philosophical basis where they want to say the token gives you voting rights in terms of how the organization is run, what it does, and all the rest of it. So a law firm could be replaced by a DAO and be a much happier place, I suspect. You see what I mean? Because the lawyers do the work, get paid, and get paid essentially what they create. At the moment, you do the work, you've no idea what the hell happens to the money. Probably gets spent on whiskey and champagne for the guys at the top. Who knows? You see what I mean? So you've got that sort of DAO. That sort of DAO will survive, but that sort of DAO is not really there for regulatory purpose. That sort of DAO is there because philosophically there is a desire to have it in place, and you're willing to spend, it's roughly about $30,000 in the first year, 20,000 thereafter, to run that DAO because your philosophy says, I want that DAO and it gives me that purpose. And that's why you got some people holding the end of DAOs, they're the tax people. You've got other people saying DAOs are the future, they're the more purist, philosophical people. It's how you do it effectively. It's really about your philosophy as a business at the end of the day.
From a regulatory perspective, it's an issue. You want to, if you have a sort of a DAO set up at the top of a regulated entity, in order to get authorized, the regulator needs to understand who are the shareholders, who are the beneficiaries. There are certain rules you need to comply in relation to governance, people responsible for that sit within the board and responsible for making decisions on behalf of the regulated entity need to be known. So it's definitely challenging to have a regulated entity that has a DAO somewhere as part of the whole.
So I'm really going to have to stop you there because we've run way over time, and apologies to the organisers for doing so. I know this is a really hot topic, so thank you ever so much, and I'm sure the panellists will be hanging around if you've got any more questions for them. Thank you.